I'm going to be simplifying for you guys what higher time frame bias is. It's something that every single ICT student should know about. Before we look to enter, we always need to ask ourselves, what is the higher time frame likely expansion? Once we have an idea of where the higher time frame is likely to expand towards, then we can arrive at a bias and we could drop down into lower time frames and look for entries. The market is drawing towards two things. It's either running to take out a high or low, which is liquidity, or running to fill in an imbalance. When it's not doing those, it's consolidating. So there's two main components that you want to look at when looking for the higher time frame likely expansion. Is price likely to expand towards a fair value gap, or is it likely to expand towards liquidity, which is highs and lows? Another thing that we need to pay attention to is fair value gaps in a premium and fair value gaps in a discount. What is that for those that are new? A fair value gap in a premium is essentially when, let's say that there's a drop lower starting at this high and then it ends at this low and it starts to reprice higher. You want to mark out a fair value gap above 50% of that range. So you're going to draw your Fibonacci tool from this swing high up here down to this swing low. Okay. A fair value gap in a premium is one that completely is in a premium, not overlapping. This middle line is the 50% from this range high to this range low. A fair value gap completely above this red line, which is the 50% line, is a fair value gap in a premium that we want to be paying attention for. That's what ICT talked about in the ICT 2022 mentorship. So if you are bullish, this can be a first area to target on a higher time frame. If it's reaching for an imbalance, you want to mark that out. If we look at it in the other direction, let's say price is retrading back down lower, we want to pay attention to fair value gaps in a discount, which is essentially just drawing a fib tool and figuring out the 50% of a range. So when it's in a bearish scenario and it's repricing to 50% and above, that 50% is called premium. When it's in a bearish example, when it's repricing lower and there's a fair value gap below 50%, this is called discount. So think bullish fair value gap in a discount is below 50%. Think bearish fair value gap above 50% is that in a premium. Okay, so these are two types of fair value gaps that I like to highlight on my chart. Now, if we take a look at price action this morning, I'm just going to prove to you guys that I'm not just going back in hindsight. I'm going to show you guys that I could actually do this real time. On the 1 hour chart right here, we have these relative equal highs. So as soon as I hop on my chart, let's say I look at a daily time frame first, you can see that this previous day's high, Friday the 12th of July, notice how it barely takes out this previous high, which is July 11th on Thursday. So when I drop down to a 4 hour chart, okay, not all of the buy stops resting above these highs were liquidated, because retail traders, they don't just put their stops right above a high, or maybe institutions, they don't just put their stop loss right above a high. They may put it to a whole number past that high. And it's just like a little layering effect where retail will have their stops. Some will have it right above the high. Others will have it a little bit higher. So when I look for price to run liquidity, I don't just look for it to run that liquidity by taking it out by 2 ticks. I want to see a sharp move above it to liquidate all the buy stops resting above those highs. Okay, so the fact that on the 4 hour time frame, this is still relative equal highs to me. Even though it did purge it here, there's still more buy stops resting above. So when we open up today, I look at the market, New York session. You can apply this logic that I'm teaching in any market session. Okay, I just view New York AM and PM session and sometimes lunch. So if we look at the 4 hour time frame, it left these relative equal highs in place. So this is an important level for me. Okay, so I'm going to have that highlighted. If we drop down to a 1 hour time frame, notice how price trades into a fair value gap. So this is a bullish fair value gap, and then it expands away from it. Okay, and then this is where we are around New York open, right at this where my crosshair is right now. The higher time frame likely expansion is the relative equal highs, because price traded into a fair value gap, it respected it, expanded away from it, and there's obvious liquidity resting above. So you want to view it and try and come up with a narrative for why price should do what it's doing. Don't just think, oh, there's a fair value gap above, it should go up to there. Oh, there's liquidity above there, it should go up to there. Why should it go above there? Well, because on Friday, it barely went above the relative equal highs. There's still buy stops resting above there. Resistance traders, they're still short, right? They're thinking that this is a strong area where the market's likely to trade lower. We see kind of slow price action to the upside here. So continuation traders are thinking rising wedge, bear flag, all these things in the retail eyes suggesting that price can continue lower. Our job trading ICT concepts is to fade that. We're trying to do the exact opposite of that. We're trying to think like smart money. So since that is the case here, the narrative is that most people are thinking that we're going to go lower. There's obvious relative equal highs. There's obvious stops resting above. And we respected a bullish PD array. So it's going to deliver from the fair value gap to the liquidity. So there's two types of things that I typically look for. It's going to deliver from internal range liquidity, which is a fair value gap, to external range liquidity, which is an old high or an old low. It could also do the other way around. It could deliver from external range liquidity, like we have right here. Notice how it takes out the level of buy side liquidity, to internal range liquidity, which is the bullish fair value gap. So the reason that most ICT students fail is because they rely on a bias completely based on their entry technique. So price will trade into an order block and they'll just be longing just because it trades into an order block. Or they'll see a breaker here and they'll just go short because of the potential breaker pattern. What ICT wants us to do is to figure out where's the market likely to draw towards, then you can get in on an entry pattern later on. When I hop on these charts, the entry pattern is the least important thing that I'm looking for, and that's what ICT preaches all the time. You need to understand what the market is reaching for. Is it going to go for liquidity, or is it going to go for a imbalance? And that imbalance could be in a premium or a discount. In this case, the narrative was that there's still a lot of buy stops resting above. So if we're already up here, it's not likely to just reverse in this fair value gap because there's still lots of stops resting above. It respected the bullish fair value gap. So the higher time frame likely expansion is the external range liquidity, these highs over here. Okay, then and only then can you drop down into a lower time frame and look for an entry technique. We're not going to be talking about that in this video, but if you guys would like a video on that, if you get this video, we'll say to 200 likes. If it gets to 200 likes, I'll show you guys how to combine higher time frame bias with entry techniques on a lower time frame, and I'm going to prove to you guys that the entry techniques are the least important in respect to finding the higher time frame likely expansion. So now I want to show you guys the exact thing that I'm showing you here. I did share to Discord members beforehand. If you guys would like to see more content from me, I have a 3-day free trial link, which is the first link down below. If you guys just want to pop in the Discord and check it out. I do share my higher time frame bias and also lower time frame setups in this ICT futures tab. You can see here is ES on the 4-hour time frame at 10:42 a.m. Exactly what I told you guys in this video is what I told Discord members. Even though ES already ran out the buy side liquidity, I think it can run it again because it barely ran that liquidity. So it was only about 8 points or 7 points to the upside for it to take out this previous high up in here. But the entry pattern is the least important because once you have an idea of where the market is likely to draw towards, you can see that it ends up spooling for that high. There are multiple lower time frame entries along the way if you can understand order flow. Price taps into a fair value gap right here. This is a silver bullet trade. You could trade the retracement into the order block with a fair value gap. That's another potential trade. So that's 2 entries right there. Again, you could find a 2022 model off of this. It runs the very, very tiny level of sell side liquidity here, creates a market structure shift. There's a fair value gap within this range. Price spools higher from there. So that's the third potential entry. This is another silver bullet. So there's multiple potential silver bullets and order flow, order block trades, 2022 models. All of that is along the way. The higher time frame bias and the likely expansion is the most important element to all of this. So if you guys are interested in seeing some more content, there's a whole library of videos in here. You could find the Discord link, the first link down below. So it's important to understand that we're not just trading the pattern fair value gap to liquidity, liquidity to fair value gap. It's the narrative of why is the market likely to go there? Where are the orders resting? Okay, that's what's most important. So it's respecting the fair value gap. There's lots of buy stop orders above. That's what the market's going to spool towards. So it's either reaching for an imbalance or it's reaching for liquidity. And when it's not doing those two things, it's consolidating. When can it consolidate? Before major high impact news events, could be right before, within the hour. It could be days before if it's a major high impact news event like CPI. It can typically engineer liquidity beforehand. Also before New York Open, right? So this is London right here. This is around 5:30 a.m. Price isn't likely to spool up for the buy stops just yet because smart money, the algorithm, they want New York traders to place their buy stops resting above these highs. So price will go into this consolidation where it looks like a seek and destroy, just going back and forth in this time period before that 9:30 open. Okay, it's likely to just chop. It's likely to run for sell stops, run for buy stops. So this can be a choppy time to trade. Price is awaiting 8:30, first of all. Okay, so we get that manipulation beneath it. 9:45 sets the low, and then it expands higher. Okay, so they're going to wait for times when there's going to be the most liquidity in the marketplace. So let's get right back on track, and I want to show you guys an example of when price reaches from liquidity to an imbalance in a premium, and that's what we have right here. So think about it from a smart money perspective. Okay, we have all of these stops. We have all of these sell stops. Okay, so what do I mean by that for those really new to this? Beneath old lows, retail traders have their sell stops. Okay, anyone long with a stop beneath here, it's categorized as a sell stop. So smart money, the algorithm, target those sell stops to engineer sellers into the marketplace so they have a counterparty to their transaction, which is they're trying to buy the market up, right? So when it takes out all of that liquidity and then it stops right in here and then expands back up, it's going to do two things. So it already ran out the liquidity on the 4 hour. Once it runs out that liquidity and it starts to expand back up, it's going to do two things. What's it going to do? It's going to reach for liquidity, or it's going to reach for an imbalance. So what we want to do is we want to see where that move started to the downside. So from this previous high, we could draw a range with our fib tool from this swing high all the way to this swing low. This red level is our 50% level. Okay. So what we want to do is we want to mark out a fair value gap that's completely in a premium now. Okay. So notice how there's no fair value gaps in here. This is the first fair value gap in a premium. Okay. So that's going to be the first target. If you study where price respected, it is the midpoint of that fair value gap. Okay, so this, it's likely to reprice up to that EQ to do two things. Okay, it's going to seek to reprice to an imbalance at a premium to rebalance the imbalance. Okay, and then also we have all of these stops, all of these trailed stops as price is continuing lower. Anyone thinking that we're going to continue to see a sharp drop lower, it's going to run back on those short sellers. So there's buy stops above there. So it's seeking to rebalance the imbalance and then also take out the liquidity. Okay, and then you can see that it does eventually completely rebalance that fair value gap. Okay, so in this scenario, once it does run out the liquidity and it's reaching for the imbalance, if we're watching price from back here, this is going to be our first target. Okay, and then along the way, we can look for entries. We're not just looking at this alone as an entry. It's the fact that, all right, the market's likely to seek an imbalance in a premium. Then I could drop down to a lower time frame and try and get aligned with that. Okay, so that's extremely important. Here we have another example on the 4 hour time frame. You'll notice that we have this deep premium fair value gap. Notice how price wicks it and respects its midpoint, its consequent encroachment. That's the CE. So if you don't know what the midpoint of a fair value gap is, it's called the CE. All right, look at this 4 hour, Friday, 28th of June. Look at that candle on the 4 hour. Since it's respecting a deep premium fair value gap and then it displaces back in the range, well, what's it likely to do now? It's likely to reach for liquidity and also an imbalance in a discount of the range. So if we take a look what happened, look at this big wick right in here. Okay, what is it likely to do now? It's likely to deliver from a fair value gap to liquidity. Okay, so internal range to external range liquidity, it also respects this fair value gap as well. The higher time frame likely expansion is lower because price respected a premium fair value gap. It showed that it didn't want to go any higher, and there's lots of sell orders beneath each of these lows in here. So if it respects a fair value gap, it can run for liquidity. That's going to be it for this video for now. Again, if you guys would like to see more on this, get this video to 200 likes, and I'll show you guys how to apply higher time frame bias, then lower time frame entries after that. I'll see you guys later.